All right. Good morning. Good morning. So, right around the world, the market sentiment has shifted. That's where all this negativity comes from. And I always point that out because I believe it's important. When when a company does something really bad and the market goes down, we all look at that and say, all right, well, there was a cause and effect. This market did something bad, like, oh, I don't know, Boeing killing entire families of people, right? Then the stock went down and cause and effect. But when it's just sentiment, when the market lost its warm, fuzzy feeling and we drop down into a new hole, you got to be very cautious because that can turn around on a dime and rip back in the other direction. Now, we're going to go through this morning and look at things that suggest, we're not primed for some kind of mean reverting flip back up. But the idea behind it is nothing sent us down here as, a particular thing other than the mood shifted. And the mood can shift again. All right, so down the most, NASDAQ at more than 1%, S&P more than 0.75%, then the Russell at 0.75%, Hong Kong above all of that, down less than 0.75%, and then the Dow at about 0.5%, and Japan coming in faring better than the rest, only down 0.25%. It's a full house. It's a very busy day with a lot of really big things happening. We are going to start to see some job numbers. These aren't the numbers that we're looking for, but it's a start to the numbers that we're looking for. Also, keep in mind, they like to throw out headline numbers and then sneak in behind when nobody's looking and put in revision numbers. So, that's important to pay attention to. We are going to get some GDP numbers and then jobless claims, durable goods. A lot of these 831s are just all tucked in there together, and then pending home sales. But it's the ECB today, European Central Bank, and Christine Lagarde. That's going to be the big deal. We do have some Fed speakers too. Waller's out chipping his teeth. Yellen's going to be on Bloomberg today. She's going to have probably some fireballs to throw. So really got to watch for that as well. Yellen, she's been around for a long time. Kind of get the mood of her. So, look around, see if you can get some kind of background on what she's going to be talking about today. They touched on it a little bit earlier, but I would want to get a little more information. Either way, she's going to be out chipping teeth as well. So we've got additional auctions. Nat gas, we had that Nat gas breakout that we've all been waiting on. Now every Thursday we get Nat gas reports. So if you're in that trade, you're trying to run, one of these wide accumulation distribution plays, one of those 6-month, 9-month plays coming up off of the lows, then you're really going to want to pay attention to the nat gas data that comes in. Every Thursday you get that data. And then tonight we're going to get more data out of Japan. So if you're trading at night, you're messing around in the Globex, really want to pay attention to the data that comes out of Japan. This ECB rate decision is a big deal. It would just be like Powell with the FOMC coming out on FOMC day. That's the equivalent of what you're dealing with today coming out of Europe. this is US dollar Japan. And we can see how we got above 150.5 yesterday. We actually got really close to 150.8 before falling back down, but there's nothing bearish about this, right? This does not look bearish at all. So the threat is still looming. That white line way up here is the last intervention spot of Japan. And I did find that video that I made last year. I made it in November. Here we are a year later, and it's present again. And yeah, I'm still cleaning the video up for release. Really, it just has some background on how far things moved, how fast they moved. And I remember focusing on the idea that they were possibly going to intervene way back here, right? Before they did intervene. And when they started to break out and start going, you know, we kept saying, oh, it's going to be this day. No, wait, it's going to be this day. It's really taken off. And they just didn't, right? They didn't intervene, and it kept going and kept going. But on that Friday, when it hit, there was no doubt. There was no mistaking what was happening. And we were able to capitalize on that. Just amazing move, right? And that's what we're waiting on, or what we're anticipating. I'm not waiting on it, but I'm certainly anticipating it. They did two. They did it on the 21st, which was a Friday, and then on that Monday, they came back in and did another one. Kind of like, you know, you knock them to the ground and then you kick them so they don't get back up again. Yeah. Don't just knock them to the ground. Follow through. So if we take another run at this, and the question kind of has to loom, you know, are they going to wait until we get up into that zone? Because if you look at where the intervention was, it popped up, and that's what gave us that spike higher. But where was the actual, you know, open that day? 150.12, and the high the day before 150.29. So, you know, somewhere in this sphere up here is where they finally intervened, and it was planned, it was coordinated, it was global intervention. It wasn't just that one nation's government by itself. You know, you can imagine it's going to take some coordination, right? They've got to pre-plan this thing and get it all prepped and ready to go. They know exactly when and where they're going to do it. And of course, it's a closely guarded secret because they don't want us to know. So we've got the ECB announcement, durable goods. It's 8:15, 8:30, 10, 10:30, 11, 11:30, 1 o'clock, including the 4-week auction front end. You can look at like the IRC and the 7-year note auction as well. So a real big powerhouse day. And a lot of these are, you know, global game-changing data points. After the close, we're going to see Amazon report. So that's a really big deal. All these numbers are my time, they're local. So make sure you're looking at these numbers on your own finance juice so that they'll match your time frame, right? I can't just go in and change these numbers. Otherwise, I would set them to market time. Because as I continue to remind people who ask me, oh, are you talking about California time? No, I'm talking about market time. We all trade the same market. I don't care where you live, and I shouldn't have to ask. You shouldn't care where I live, and you shouldn't have to ask. We all trade the same market, so we should all talk market time. Sadly enough, and as much as I like the guy, Tom Salznoff has been pushing hard for Central Time because of Chicago, right? Tasty Trades and Chicago as the time that he uses on everything, which just kind of screws up the whole thing. I think he's just bucking the system just to be bucking the system. Either way, market time. So let's start with the weekly and do a little top down. We are through every single major moving average. There are none left on any time frame underneath us. Now, there's the 200 if you really want to focus on that. I wouldn't. You know, the 200 is like looking out the window and seeing if it's raining or not. That's pretty useful, I guess, but it's not a weather report, right? It's not a forecast of the weather either. It's just, is it raining? Are we above the 200? Yep. All right. That's about as useful as the 200 gets, right? Especially on a weekly, a monthly, quarterly. But the 50, the 20, the 10, we're underneath all of it. So any move back to the upside is going to be a significant drive. It's going to need a powerful push. It has to be some sort of event, some sort of catalyst, because there's nothing out there that would turn this market around. Sentiment alone, right? And in fact, as bad as it is now, sentiment couldn't do it even if it wanted to. There's just too much to get through. When we're thinking about pure price methods, this is a classic topping pattern, and it has given all of the clear signals that it is supposed to give. So that lower high, even this low here, whether we had a low here to argue about or not, or if we were going to have to use this one back here, we've got two different topping patterns. So this low isn't really too important, but this lower high was. Then setting this pivot point and that lower high. So breaking through there with this breakthrough, when we just kind of chopped about, that breakdown wasn't really confirmed, right? Because this isn't really good stuff. But now that we've got a full expansion off of that pivot, that counts. So a breakdown and a new breakdown. That's a full-on valid 100% drive to the downside. That's a trend on a weekly, no less. That does not change on a dime. A lot of places will talk about how far down we are from the high. Some places say that a 10% drop from the highs puts us into correction territory, and that below 20% would put us back into a bear market environment. Now, I don't know about you. I don't want to wait for the market to drop 20% before I decide that we're in correction territory, or that we're in a bear market. It is a bearish trend for sure. There's absolutely no doubt about this. And whether you were using moving averages or pure price method, the trend is your friend, right? You ride with what we've got, not what you think we're going to get. And everything points to a continuation to the downside. Just remember what I started with today, that sentiment shifts in the wind, right? So we're on a daily. We have a daily gap here between where we closed and where we opened back up in Globex. This is a different gap than the typical gap that we get, right? The typical gap is where we open in Globex versus where we open in the RTH. And that gap is what we normally trade in the futures. But this is different. This is a gap between where we closed at 4 or 5, if you want to consider the 5 o'clock close, the real close, and where we opened at 6 o'clock. It's one of the reasons they don't want you to hold at the end of the day when you're in a futures trade, because that 1 hour window can have a gap like this and it'd really chop you up, right? You're completely vulnerable. None of your stops, nothing would function in that 1 hour. And so you could just really get hurt. So we've got this gap to fill, but then we're also going to have another gap. between where we closed last night on the COG line at 42.11, no less than that, and where we opened this morning. So 2 gaps to deal with. Now, it's not unusual. We've certainly seen them before. Here was a close on Friday the 13th, and then that following Monday on the 16th. That's the kind of gap between RTH close and Globex open. That's usually where we see it, is on a weekend. But we're getting it in the middle of the week. So it's not unheard of. But it needs to be put on your radar as something that we got to focus on. We also want to take yesterday's candle, plot it out. 50% of yesterday's candle is 41.68. 100% of yesterday's candle is 41.34. The volume's a little heavy today. It's not out of line, but considering that we've got, some really large data coming out of Europe, we would have expected some sideline activity, right? That they sit out and wait for this data, and that's not what they did at all. Now, the spot gamma levels that we're looking at there are not the true levels, so you got to give me a second while I grab the right ones off of spot gamma. It has to be imported every day, which is a little tedious, but whatever. One of the things that we try to keep track of on a day-to-day basis is has the call wall rolled? Has it moved up, or has it moved down? Because then it gives us an idea of what's going on in the bigger picture. What are the institutions doing? What are the market makers doing? And just like that. So the put wall is still over our head. It's one of those mornings where we kind of want to just double check the numbers. $42.23 updated Thursday the 26th. So these are the numbers. They are updated. It is over our head. 42.23. So we're underneath it. The thing about being underneath this level is that we don't look for them to monetize the puts at this point, right? We don't look for mean reversion. We look for them to sell into selling. And if we begin to rip to the upside, then we'll look for them to buy into that buying. But being under the put wall, we look for an expansion. We can actually expand much further to the downside. They use a dot plot when they're teaching about the put wall and the volatility levels, and in their dot plot, we'll just use that green line right there. They'll show how far a market moves to the downside once it crosses through, say, the put wall. And the distance was considerable. We're talking about, dots that were showing up a long ways away from the line, as opposed to when markets would get above a call wall and they still would be relatively close to that call wall. They didn't have this kind of runaway expansion to the upside. So they kind of made a little offhanded comment about when a market crosses through the red line that it can fall, all the way to zero. Obviously, our market's not going to go to zero, but in general, markets can fall a lot longer and a lot farther than anybody ever thought they could. We saw that in COVID. Of course, triggers would kick in, right? There's lock limits. But right now, 42.23 is going to be a significant level to get through. It's going to be difficult to get up through a put wall. $10-day, 30-minute volume profile. We're at the low of the profile because we're making these lows as we go. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. The point of control is still a long ways off. The idea was that if we kept chopping around that 42.50 to 42.20 area, that we would eventually bring that point of control down to us. Well, inevitably, we're going to bring it down to us. You can see how the TPO, the blue profile here, already has brought that point of control down. And that's because we've spent more time down at this level than we did spend back here at this higher level. All right, TPO is generically volume by time rather than volume by price, which is what we have in green, right? So we put the two together, volume by time and volume by price. We could see icebergs, ceilings, unusual volume pockets. So we've spent more time down here. So we have the point of control down here already. But as the days go by, once we lose more of this Thursday data, this column of volume up here won't be so tall, and the point of control will automatically be brought down to where the highest level of volume is at. So tomorrow when we come in, maybe not by tomorrow. There's some Friday volume here that might still hold us up, but I think it's going to happen by the end of today. Tomorrow when we come in, the point of control should be down at this 42.60 and be a lot closer to where this point of control is at. Either way, any move to the upside is going to have a significant resistance at that 42.60 area. It's just a lot of work that's already been done there, and the expectation is that there's going to be more work to do if we do go back to that spot. We're going to add another VPOC. We have one now from yesterday. Looks like it's right on the cog line, 42.11. Yep. Gotta love them cog lines. All right, nothing really stands out between the volume that we have this morning and the TPO. So we're just going to carry forward that 42.11, the cog line. And we do have an old VPOC 41.23. It is old. We're not in those contracts anymore. I'm not sure how much weight that carries, but I'm pointed out anyways. It's because we did carry it forward. It hasn't been hit yet. And you know, it's a reference point at the very least. We are nearing the edge of the weekly expected move. That's at 41.61. There's no reason to really worry about the ticks. It's just 41.61 or 41.60. You know, it doesn't have to be spot on tick perfect. 80% of the time, the market will close inside of this range. That's how accurate the S&P is with its expected move compared to any other market. And it used to be because it had a higher trade record than everything else, right? It was the experimental product with when weeklies first came out. Then it was the experimental product for 5 expirations a week. And it's also just the most heavily traded product in the entire world. So, you know, the more trading we get there, the more accurate the data points are. And so it's just always has been a more accurate expected move than any other product. And it continues to still be that. But it's a warning when we fail that 80%. Now, I don't know about you, but I don't want to go back and count every single week that we've had over the course of this year or in the course of a 12-month time span. So I just use 10 weeks. 10 is a perfect round number. If we close inside these boxes 8 out of 10 weeks, then we've got our 80%. It's generic, but it works, right? When we fail to close inside this box 8 out of 10 and it starts to slip, and 7 out of 10, okay, that's not too bad. At last count, we're at 6. It's a 60% accuracy rate, which is so close to coin toss that it's not even valuable at all, right? It's worthless. But it's a signal too. It's a warning. Markets expand during volatility events, right? And the more volatile the market, then the more we move. Volatility is a nerd word for movement, and implied volatility is just a fancy way of saying promise. So we put the two words together. Implied volatility is promised movement. In higher volatility events, we expand farther than the average, and we go farther than what we should with a calculated expected move. So breaking the range is part of it. Staying outside of the range is the bigger part of it. And then there's how far outside of the range did we get? Not too long back, we broke the weekly expected move on that week right there. So we'll just zoom in here a little bit. And we expanded, quite a ways past the edge of the expected move, nearly 2%. Now we did try to come back up a little bit. It didn't work. And then we closed near the low of that day on that Friday. But that wasn't too bad. And it all happened on the later part of the week. Just like today, if we were to cut through the edge of the expected move today, like they did on that Thursday and close near the low of the day. But we would need something like a 2 standard deviation before we start to really kick in. See, the thing is about these futures is they're hedging in the SPX options, or rephrase that, they're trading in the SPX options, very large trades. Options have a fluid delta to it. So if your trade begins to lose and you want to get back into a more delta neutral position, you need some deltas. Either you need to sell some deltas or you need to buy some deltas, very much like beta weighing. Futures have a hard delta. So if we expand too far outside of this box to the downside, they will sell futures and sell into selling to get their options trade in the SPX back closer to a more delta neutral position. Now I've demonstrated what that looks like before. We can actually use, the analyze tab and put trades in there and then show how we can rebalance those deltas by buying and selling in the futures. The point though is that won't kick in until we get, a real considerable distance away from that red line. So watch the weekly expected move. Yes, by all means, keep your eye on the weekly expected move, but how far past the edge we go is going to be really important. Not just, getting to the edge, not getting outside of it, but getting far beyond it. That's 4140 on the SPX. Now we got a halfback level at 4150 on the SPX. It's worth noting, if you set your chart to 1 year, that's your halfback level. If you set your chart to year to date, so starting in January and just running forward, the halfback level was cut through yesterday. It was 4,200. Now, I run a strategy when it comes to trading these halfback levels. It's called a halfback break. And when we break the halfback level, we target 25%. So if we're doing it from the downside, the target is 0.75. And if we're coming through from above, the target is 0.25. Well, we broke the halfback level. So if we did put the 0.25 on there, I guess I've already got one. So we'll just add this one. $3,997. It's close enough to 4,000 that I wouldn't haggle about it. 4,000 is just a nice, easy round number to deal with. That's the downside target if we break that 50% mark. Now, I'd rather break it with a weekly close to use a target like that, but that's kind of the target. That post just reminded me, by the way, the options markets had some issues yesterday between the CBOE and it wasn't one broker. It was Webull, Tasty Trades, Thinkorswim. It was across the board, everything. And man, there were some very pissed off people. You know, it happened near the lows of the session at that time. So people lost control of their broker. They couldn't exit out of their options trades. Then the market spiked to the upside. Everything unfroze. People got stopped out of all their puts, and then the market dropped back down again. So really, and it happened, the connection between the brokers when it came to these options, with just our options markets, it happened more than once. The connection was off a couple of times yesterday morning. And it was nearly every broker. I was in the futures yesterday more than options, so it didn't affect me, but it could have, you know, that could have been me just as much as anybody else or you. And I bring it up because I had somebody yesterday afternoon complaining about their broker, and they thought it was just their broker, you know, like, oh, my stupid broker, I've got to get another one. This thing is just, you know, I just can't trust it. But it wasn't their broker, right? It was the data. The options data comes from a source, and that source is what most brokers are using, right? The brokers get it from that source and they give it to you. Well, it wasn't your broker's fault, right? It was where they get that data from. It was their fault. So, you know, if you're grumpy about your broker right now, thinking that incident yesterday is the last straw and you're going to go get yourself a different broker, just hold up, right? Because it wasn't your broker. It was the situation. So there's everything out there right now is negative. There's nothing really that would, you know, turn this around off the top. All right. But if we're looking for that question to be answered, have we fallen too far too fast? Does it owe us a little bit of maybe a mean reversion this morning? You know, from that point of view, we're 3.62% away from the 10-week moving average. Other than COVID, which we want to just, you know, kind of scroll past that so the rest of the data makes sense, we can see that we've gone beyond the 10-week moving average, 4%, 5%, 6%, 7%, even 8% away from the 10-week moving average. So sure, you know, we're down a little bit, but we're not past even 4% yet. So last year, for an example, the Jackson Hole mic drop moment when Powell told everybody to suck it up and we're going to, you know, be higher for longer, that sent us into a tailspin down into the depths of October before Bank of Japan intervention, and we come ripping right back out of it again. So, you know, 2 times last year when we got below 6%. Otherwise, getting somewhere around 4.5, that's going to be about the turning point. It doesn't mean that we're going to run back, but until we get there, we really can't consider any kind of language that's talking about an oversold condition that owes us a pause or that owes us a rally back in the other direction. Remember, the moving averages can catch up with us. All we have to do is quit moving, right? Just kind of chop about. So that's the 10-week. So, on the weekly point of view, we're not oversold. We're getting close, maybe, but we're not there. On a daily, we're 2.25% away from the 10-day moving average. And you can see how that's just about the sweet spot. Sure, we've gone farther than that, but generally speaking, that's about the sweet spot. That's about where we would expect the markets to quit falling, start digesting, maybe turning back and go in the other direction, but it doesn't really owe us a move, right? It doesn't have to. It can just stop falling. So this is kind of implying that we've moved to the downside just about as much as we're going to move to the downside until we digest and let that 10 get caught up a little bit. At Investors Business Daily, they would use phrases like, well, no, like stock charts, they'd say it needs to heal, right? That the market is disrupted. The charts are disrupted, or, the pattern is broken, and we just need to heal a little bit. Parabolic moves, big gaps, things like that, they disrupt analysis, and we got to get some cleaner perspective. So I'd say let it digest around these levels. I wouldn't expect really big expansions from here to the downside, but there is this thing called capitulation low. Kind of is just like what it sounds, right? It gets to this point where the market, say newer traders or just really frustrated individuals, they can't take it anymore. All right, their max pain has been met, and they throw up their hands and just dump everything. And it's usually right about the time that we flip and go back in the other direction. In fact, it's almost a signal for the buying to pick up, right? Say like back here in October, when it had that really deep below, it was just one of those capitulation days where they said, screw it, I've had it, I can't take it anymore. You get that big, massive dump. Everybody comes in crazy bearish. And you can see on the SPX, we had gapped down all the way outside of the box that morning. And we went even just a little bit lower. And then look at that recovery. I mean, the distance of that candle. The SPX from its highest to its lowest point, 5.25% in one day. Right? So is it going to be like this? I don't think so. I don't think it's going to be that sort of a morning today. It wasn't bearish enough in the media that I was looking around at. There's no fear out there, right? Nobody's really concerned about it. It's like, yeah, whatever. We all got an idea what's going on. So I don't think it's going to be that sort of a morning, but we're set up for it, right? We kind of had this set up on the 23rd. We opened up, gapped down. We had that little bit of a lower edge, and then it ran up, and it really looked like we were going to just have one of those days, just like back here, right? When we closed here and we opened, gapped down, kind of swung down to the edge of the expected move, and then had a ripping day all the way up. It looked like that's what we were going to get on the 23rd. And instead, at the high of the day, we just dropped, right? It all went into the toilet. It was done. And down we went. So here's a redo. We're going to be opening up, gapped down this morning for sure, right? I mean, there's no doubt about that. The question is, are they going to flip it? Or are we going to open massively down and continue to expand farther down? I don't expect to open gapped down and continue to expand farther down. That's really going to be based on what we get out of Europe today and some of the data like the GDP and all that. So all eyes on the news, unfortunately, right? Or I hate those days when we're totally dependent solely on the news without being able to carry a narrative. And there's a lot of different news in here today that could change it more than once. And we still got to keep our eye on Japan. Okay, because that's still not done yet. So for a move down today, I'm thinking 4,100 in the SPX. The ES right now is down 0.74%. That gets us to 4,150. I'm rounding a little, but that's close enough in the SPX. If we hold where we're at in the ES going into the open, the SPX is going to open somewhere around 4156, 4150. We can drop 50 points, no problem. But let's get to that cog line, or the weekly expected move, 4140. Let's get there first. We've got a market maker move of an additional 0.5%. So these ADR lines aren't going to be useful for us. We need the new ones, right? And we won't get those until the SPX opens, which is why I use the ES in the mornings. Now we could use SPY, sure, but this has more data, so we'll use this. We're on the edge of the weekly expected at the ADR half already. From where we opened, that's where it splits the difference. Generically, I'm just kind of ripping it up there. That distance is the ADR, which is 1.5%. The question is, what if we go in a single direction 1.5%? Then we would be at the full ADR. We then want to take and add the market maker move to it, which the ES doesn't have a market maker move. The SPX does right now. That can change. Just want to keep your eye on the ES and see if we do get a market maker move. If we use the one that we just saw in the SPX, it would be an additional 0.5%. So one way to do that is just to take a 0.5% from the yellow line. That would get us to the cog line 4111. I'm rounding, but it's close enough. We could go to 4111 in the ES and it wouldn't be considered oversold. It wouldn't be considered a big move on the day. That'd just be an average move. The thing is, what we do on a normal daily basis is the red line. The red line is 21 days of regular, everyday, normal price action. So it would make sense that we do today what we've done over the last 20 days. Going up to the red line. That's the norm. It's what we're supposed to do. We got the Japan 10-year expanding above 88. This big gap here is really worth watching. And it brings us over to US dollar Japan, the pair. We are holding above that 150. And I mean, look at the size of this candle today. Now, I don't expect their intervention today. I really don't. I'm biased on this idea that they're going to do it on a Friday. And they don't have to. They really don't. But I just got this sneaky suspicion it won't be today because today's not Friday. And that's my bias, right? It doesn't have to make sense. I don't have any logical reason to believe that it's not going to be today and that it has to be on a Friday because it really doesn't have to be on a Friday. So we want to stay aware of this, right? Even though I don't think it's going to happen today, it totally could. Facebook's down the most, of course, but that's with the earnings. The financials are down the least of my little group here. Just the equities that I wanted to keep track of. Get into the screener. %41 of the NASDAQ is down 0.5%. 21% of the NASDAQ is down more than 1%. And the NASDAQ futures has flipped over off of those lows set at 14,300. We're up 150 points from that low this morning. So, things are trying to throw off the yoke from the Facebook earnings. They're already 14.3. Excuse me, I misspoke. I'm on the wrong time frame there. We're up 50 points off of the low this morning. The low that was set, hours ago. So they're turning around, they're getting better. But we still got 21% of the S&P down 1%. %44 of the S&P is down 0.5%. So we're broad based, right? It's that rising tide or falling tide. And that's a really big deal that we want to focus on, right? That this is going to take more than just one or two names to turn things around. It can't be just the fangs that bring us out of this hole that we're in this morning. And I really think that the biggest thing today is going to be the news that we get today and how the market takes it. So watch the clock. Keep your eye on whatever news source you like. I kind of like Finance Juice. For those of you that are using Thinkorswim, you do have a tool on here that is often overlooked. This trade flash is run by Hammerstone Markets. If you was to go to the Hammerstone website and buy a subscription to Hammerstone services, it's hundreds of dollars a month. It's a very expensive service. This is a limited version of it, but it's still a version of it. Totally free. It's on your Thinkorswim. So you just hit the plus down at the bottom, add a widget. It's called Trade Flash. You can put a name in there if you want to search to see if anything came through on a particular symbol. And you can just leave it blank if you want to see anything that's coming through. And you'll be surprised. It has UOA in it. UOA is unusual options activity. It has news. So if something that they deem market relevant, they'll put it in there. It'll spot whale trades, dark pool prints, big delta orders, all kinds of things land in there. And it's free. It doesn't cost you anything. It's called Trade Flash. All right, everybody, be careful, be safe, watch the clock. I'll see y'all tomorrow.